All right, welcome everyone. It's a pleasure to have Andrew Palmer here presenting his new book just out. Apparently the copies you see there are not really the copies meant for distribution. They have been shipped here in extremis just for you today. So this is really, really new stuff. I'm very pleased that he can come and present this new stuff here. Andrea Vedolin, who is here, she will chair the meeting. And I just want to say a few words. I tried to convince Andrew that all the ideas in his book actually came out of a discussion I had with him many years ago. He very kindly denied having any recollection of that discussion at all. And so all the ideas, therefore, must be his truly. The reason we are excited to have him here in the Systemic Risk Center is because I will give it a systemic risk spin to it, the book being on financial innovations. And what he spins very well in his book is this trade-off between innovations being necessary and required to make systems work properly because of inefficiencies in the system. There have to be innovations to bypass the inefficiencies where money doesn't flow the way it should be. So innovations are required to make the system stable and to remove systemic risk. At the same time, I'm sure we'll hear lots of horror stories and war stories, how these innovations and derivatives and things like this have been used for other purposes and create systemic risk. And so there will be this balance in this book between the good and the bad, and I'm looking forward to learning all about that from you. Thanks, Andrew.
Sure.
So we're all very excited to have Andrew here. So Andrew has been with The Economist since 2007, first as a banking and then finance expert, and since 2013 he has been the head of data journalism. So Andrew is going to talk about the root of all good. He's going to talk about financial innovations. So if you followed the financial press since the financial crisis, you probably sense this slightly negative connotation with financial derivatives. So he's going to give a different view. So he's not just talking about the bad things, but also the good things and how financial innovation is going to solve some of society's problems. So before we start with the talk, some organizational things. So if you're a Twitter user, please use hashtag LSESRC. I would also kindly ask you to turn down your mobile phones, not to disturb the event. After Andrew's talk, there's going to be a Q&A session, so if you have any questions, please keep them until the end. And after the Q&A session, Andrew is going to sign his excellent book just in front of the venue. So please welcome Andrew for his talk.
Thank you very much, and thank you for coming. Thanks to the LSE. I was here 20 years ago doing a master's, routinely skipping lectures, and when I was here, not really listening. So I hope you don't repay me in kind tonight. I'd also like to thank the SRC. I come too infrequently to your events, but they're always incredibly stimulating. So the work you do is fantastic. So I'm going to talk about money as the root of all good, and in fact I feel more conflicted about finance than that. But the reason to use that terminology is because we're all aware of the idea of finance as being a pernicious and destructive force. And it's not just pernicious for humans. In 2005, a group of Yale academics trained some capuchin monkeys in the concept of money. And they trained them to use tokens in exchange for food. And it went incredibly well, and the monkeys started to respond to price signals. And when they could buy more of one type of food than another, they used the tokens accordingly. But then other types of behavior started to emerge. One monkey strayed into crime, running off with a full tray of tokens. Another was seen paying another monkey for sex. So money had distorting effects. And such pernicious effects, such deep neurological effects also, of course, affect humans. In another experiment, a group of volunteers were given a $50 cash pile, and then they were shown a series of animated Wheel of Fortune spinners, which could either subtract or add to their cash winnings. And they were wired up, and people were looking at their neurological patterns. And as they did well, there was lots of activity in the brain that exhibited a very familiar pattern. And the researchers were a bit stumped at first because it looked very, very like something else. They couldn't quite work out what it was. And then they realized it was exactly the same kinds of patterns exhibited by cocaine addicts and first-time morphine users when they get dopamine rushes. So money has an addictive quality that is potentially very destructive. My own experience of finance in many ways reinforces that narrative. I started covering finance for The Economist in 2007. It was the week that there was a run on Northern Rock. And for the 6 subsequent years, all I saw was large-scale incompetence, mismanagement, outright criminality. It wasn't a particularly impressive scene to behold. I met people who were smart, and I met people who were mediocre. I met people who were walled off from reality. The banker who bemoaned the fact that his bonuses were getting smaller and said he might have to go and live on the south of France on his olive farm if things continued this way. So there was a sort of great sense of groupthink that pervaded the industry. As I say, you sort of expect me to come out of that experience thinking that finance was all bad. But in fact, I came out of it thinking that the narrative was totally one-sided, that it lacked nuance. Yes, finance screwed up in very, very fundamental ways, but it also has the power to do great good. Yes, there are dangers from finance, but not perhaps in the places where you'd expect. And yes, financial innovation can go very badly wrong, as we saw, but it is also the answer to the flaws in the industry that we all worry about. So I want to run through each of those propositions tonight. And the first is that finance can do good. Now, in some ways, this ought to be a very uncontroversial proposition to put forward. If you think about the history of human civilization and economic progress, finance has been there holding humans' hands all the way through. When people wanted to trade, they invented money as a means of exchange. When farmers wanted to invest in livestock, they invented debt. When seafarers wanted to mitigate the risk of shipwreck, they played with rudimentary forms of insurance. But it's still doing so, and that's what a large chunk of the book talks about, the ways in which finance is still solving problems. There is a meme that finance has got so big that it can no longer be useful. And there's something to that. There's certainly a case to be made that finance flows naturally to activities which are not so productive, and I'll come back to that. But it's clearly nonsense to say that there are not problems that can be served and solved by the financial industry. And I want to give 3 examples tonight of many that occur in the book. So the first is around harnessing behavioural insights to help poorer people to save more. So in America, 40% of people cannot get their hands on $2,000 quickly to cope with an emergency. The figures are roughly similar in the UK and continental Europe. Those people could try and get credit, but that's increasingly difficult in the re-regulated environment. The banks are now under pressure to husband their capital, to use it wisely, and that implies directing it towards wealthier people, the people who will end up taking out mortgages or investing in assets. So the credit route is curtailed, not least because subprime mortgages is no longer a route for people to unlock cash. Payday lenders is another route. There are more payday lenders in America than there are branches of Starbucks and McDonald's. But we also know the pitfalls of that kind of lending. The common sense best answer is to try and encourage people to save. And there's an unintuitive way to get them to do so. And that unintuitive way is through lotteries. Humans love lotteries. These charts show how many people across various countries indulge and lose. Australians lose the most per head. America is the market where most money is spent on lotteries. And American households spend more on lotteries each year than they do on dairy products or alcohol. So people love playing lotteries, and that's an impulse that finance has actually harnessed in the past. The idea of limited liability is in some ways about harnessing the lottery impulse. You put in a certain amount of money, your losses are capped on the downside, and there's a chance of a jackpot if things really go well. Premium bonds, another example here. So that insight has been harnessed by a small fund in the US called Doorways to Dreams. And what they've done is set up a series of what they call prize-linked savings accounts, but which are in effect micro-lotteries. And they are targeted specifically at low-income people, and they encourage people to put in increments of $25, and for each increment, they get a raffle ticket. And there's a cap on how much money you can put in, so that this is not then played by the wealthy, but that means that people are entered into monthly and annual draws. The prizes that are available are not that great, but that doesn't matter. Just the idea of a payoff is what matters. And in the 5 years since these started, initially in Michigan, but now in 4 states, Doorways to Dreams has accounted for an incremental $100 million of new savings from the poorest people in society. Very low-tech example, very sort of common sense, but a great example, nonetheless, of finance tweaking things, playing around with behavioral flaws to good effect. The second example I want to draw attention to is on a grander scale, and it's about big social problems. So there are 2 sort of issues that dog public spending at the moment. One is that there is clearly pressure on budgets. There's less money to go around. There's pressure all across the rich world to curtail public spending. The second is that a lot of that spending, by no means all, but a lot of that spending is often wasteful. So if you look at America again, there were 10 federal spending programs that were rigorously evaluated using randomized controlled trials between 1990 and 2010. 9 out of those 10 programs either did no good at all or were actively harmful. My personal favorite is one called Scared Straight, which put juvenile offenders in contact with hardcore criminals with the aim of, well, you can guess, it didn't work, surprisingly enough. So you've got 2 of these problems, pressure on budgets and wasteful spending. And one answer to that is the social impact bond, which aficionados of finance will know about, but doesn't get a lot of play more widely. The social impact bond is an idea that you can cram in private capital to fund discretionary public programs. If those programs are successful, they will result in cash savings to the state, and those savings can then be used to pay back the original investors. And the first example of a social impact bond, or a SIB, was in Peterborough, and from 2010, which is when it started, and it's still running, a program has been going to fund prisoner rehabilitation programs for people coming out of the prison in Peterborough who've served sentences of under 1 year. What happens is that that money is funding a much more intensive intervention with prisoners than the normal process for ex-convicts. People are met at the gates. There is an effort to ensure that they have money for accommodation on night 1, because many of them reoffend in order to get back into prison for shelter. There is training provided for basic construction skills for people who haven't basically had much opportunity to do so in the past. And their outcomes are measured against a national control group, and if they're sufficiently good, then there will be a payout. The first payouts are only due in 2016, but we have interim results. They have resulted in much better outcomes relative to the national control group. And more to the point, this one example is now spreading, if not like wildfire, certainly fast, around Britain and beyond. So in Britain, there are now SIBs that pay for multi-systemic intervention for adolescents who are troubled to keep them out of state care, that pay to prize entrenched rough sleepers off the streets of London by using very, very rigorous and careful intervention, actually, to ensure that kids that are particularly hard to place for adoption can indeed be put into family care. It's also spread beyond Britain. There are about 20 SIBs now operating in the UK, but there are SIBs in the US, in Europe, and indeed in the developing world. So the DIB, or the Development Impact Bond, is the same idea, except rather than the state paying investors back if things go well, it's multilateral aid agencies. And the only reason for showing this chart is to drive home how, if we are seeing good results in the rich world from prisoner rehabilitation programs, think how much more effective or how much greater the returns would be if you were doing the same kind of thing in a place like Latin America. The final example of finance doing good is more high-tech, more advanced, if you like, and that's around financial engineering in order to encourage the development of promising medicines. So Andrew Lo, who's an academic at the MIT, has formulated this very provocative question which pits the two great villains of the age. Can financial engineering cure cancer, is the question that he's asked. What he's getting at is a phenomenon which is known cutely as E-Room's law. We all know what Moore's law is, the idea that computer processing power doubles every 18 months or so. E-Room's law just inverts that. And what it's referring to is the fact that for every $1 billion spent on drugs research at the moment, the number of drugs that results in as being approved by the US FDA halves every 9 years or so. There is a term in the drugs industry called the valley of death, and that is the translational period when promising medicines go from being in the lab into clinical trials. That's when the risks of failure are highest. It's also when capital is scarcest. It's very, very hard to get people to put money in. So Andrew Lo's idea is to create a fund which basically puts together up to $30 billion worth of capital. And in that fund is a portfolio of promising early-stage medicines. Some are slightly later, and they're already producing royalties. Some are just gleams in the eye of researchers. But the idea is that with a large enough fund, you get more shots on goal, the classic argument from diversification. He also wants to use techniques around securitization. Now, securitization people think of as a technique for blowing up the world economy. What it just means is smooshing together income flows from lots of different products. That's how he wants to structure this fund too. So lots and lots of medicines which push off this income flow, tranching techniques which mean that creditors who are particularly risk averse can sit at the top of the hierarchy and can take first bite at those royalties. So it's a piece of, I mean, it's not particularly complex financial engineering. It is nevertheless using a technique which is widely suspected for the greater good. It will take a long time for a 30 billion fund to come together. But there are small examples already. There's an equity fund which does exactly this, which listed in Dublin last month. And there are talks going on right now with US government medical research agencies to try and make this work at smaller scale for orphan diseases, which are very rare genetic diseases. Those are three examples of finance doing good. I hope, and I'm happy to talk about other examples in the book, that they persuade you that ingenuity in itself is not something to fear. So what is the reason to fear? Because it is clear that finance does have a habit of taking good ideas and systematically making them sour. And my contention in the book is that the thing to fear is not the new idea, but the established market, and in particular, the way in which those ideas become big. So one issue is heft itself. And this is just the obvious point that things that are big are capable of bringing down the financial system. Those are the ones you need to worry about because they have the capacity to do greatest harm. But there's also the point that things get big by doing things in a particular way. There's standardization of language and documentation. And there's also the idea of safety. There's a particularly good academic paper, which if you can skip past the algebra, crudely put, and this is by Genaioli, Schleifer, and Vishny, crudely put, lays out a sort of schematic for how innovation leads to financial fragility. And it goes a little like this, that investors want to get their hands on a particular type of asset, let's say treasury bonds. But there aren't enough of them to go round, so the industry creates things which looks kind of safe, like treasury bonds, but offers a bit more in the way of returns on top. So mortgage-backed securities fit into this topology. AAA credit rating, fantastic, that looks safe, but you get a bit of juice in terms of your income as well. There's another example, which is the money market fund. And the money market fund stampede during that week in September 2008 was the thing that most worried US financial regulators. The money market fund basically offers the same security as a bank deposit, says you can get your money back when you want, and the principal won't be dented. But it also offers the opportunity of greater returns on top if the markets go your way. So it's not the dash for risk that should worry people. It's the hunt for safe returns that's really worrying. That's where people flow at scale, and in a way that makes them unprepared for things going wrong. You don't expect a AAA credit rated instrument to suddenly start defaulting in huge numbers. You don't expect a money market fund to break the buck. So when that happens, there is panic, and finance cannot cope with panic. Now, if people were looking closely at these instruments, then there wouldn't be a problem. But the trouble is, once you get beyond a certain scale, you don't have specialized investors anymore. You don't have people doing lots of due diligence. You have a machine which pumps ever faster, which is being driven by competitive pressures to go down the credit ladder, to add a little bit of leverage, and which starts to create heuristics, or rules of thumb, that make it much easier for investors who perhaps don't know these instruments or asset classes that well to start to invest. Now, heuristics are incredibly useful. We've been using them since we were hunter-gatherers to run away from danger the moment we centered it. The trouble is that in finance, the heuristics tend to attract people towards danger. So in the mortgage boom, before the crash, the FICO score, the credit score that sort of pervades America's financial system, was one such thing. It set a cutoff. It said that if you had a credit score of 620, you were safe, and if you were below 620, you weren't safe. And what happened is that there were higher default rates above 620 than there were below 620 because people weren't paying attention. The AAA credit rating I've already mentioned, that's an obvious example of, and perhaps the single most destructive element of the build-up to the crisis, of a heuristic which completely lulled people into a sense of false security. Papers that look at the AAA credit rating show that every other credit rating, investors were being discerning, that yields moved around in a way which actually had some predictive power. AAA credit ratings had no predictive power in terms of their initial yields. People just looked at that and bought. They didn't think any further. So you've got all these things coming together. You've got heft, you've got the idea of safety, and you've got unspecialized investors. And people will often write about how, the next meltdown won't be like the last one. You can be sure of that. Well, I'd say that's total rubbish. The next meltdown will be in exactly the same place as the last one and the one before that, and it will be around property. Property is the world's biggest financial asset. It grew incredibly fast in the run-up to the boom. You can see here mortgage lending as a percentage of total bank lending, and this is a very long-run chart, but just in the last 20 years alone, the growth in private sector debt as a percentage of GDP was driven almost exclusively by mortgage lending. And if you think about the qualities of property, you could see immediately why we should worry. Of course, it's very large. It's got tons of unspecialized investors in there. That's you and me and everyone else making decisions based on what the weather's like or what the neighbor's house sold for. We have the illusion of safety, not just in our own minds, the idea that we have something tangible from putting money into a mortgage, but also hardwired into the financial system. So capital regulations privilege lending against property. Bankers themselves think of property as being incredibly safe because it's secured lending and it's collateralized. And this brings us back, I think, to the point about finance being less productive at scale, the idea that the bigger it gets, the less quickly we grow rich. And that's because property is the thing that capital gloms onto beyond a certain scale. It's incredibly easy to put that last extra dollar towards property. It's secured, it's tangible, you can see what you're going to recover in the event of a default. But it's also the thing that's there at the scene of the crime. Every time there's a banking crisis of any magnitude, property is somewhere there lurking. And I think that's what we should worry about, and that is clearly not what the regulators have worried about, or the politicians in the aftermath of the crisis. We have a political and public discourse which talks about the casino investment banking and the utility of the retail and commercial banking world. The utility is the place to worry about. We have an election campaign where people are falling over themselves to prop up demand and to ensure that first-time buyers somehow get onto the ladder. No sense of addressing the supply question. It's all about this most sacred of constituencies, the want-to-be homeowner. So I think there's a major problem with where people have diagnosed risk in the aftermath of the crisis. It's not the wild schemers in the investment banks, although they had a part to play in some of the complexity of securitization. It is the much more simple, humble asset of property and instrument of the mortgage. The last proposition I wanted to talk about was around how financial innovation can help resolve some of finance's major flaws. So property itself is actually a place where we should see much more innovation. It's incredibly hard for entrepreneurs to fight all of those policy headwinds, interest rate deductions, all of the giveaways that we see here, make it very difficult to fight. But there are some interesting examples of entrepreneurs using shared equity mortgages or creating classes of securitized bonds which use rental income as opposed to mortgage payments in the US. But away from housing, there are plenty of examples of innovation and entrepreneurship which are making really big and interesting strides towards a new financial system. And this is the Fintech wave, financial technology. So when I was looking closely at the industry, I saw sort of two big acts of a three-act drama. One was the crisis itself, the second was re-regulation, and the third is now underway, and that's the rise of alternatives to the banks in all sorts of areas, from payments to credit card lending to equity crowdfunding. Goldman estimates that there is $4.7 trillion worth of revenue in financial services that's addressable by these new companies. We're a very, very long way from getting to that sort of number, but there's a huge opportunity there. Loads of venture capital money going in, clusters springing up in London around Shoreditch, in New York, close to Wall Street, and of course in San Francisco, to try and take advantage of some of the failures of finance that became so clear as a result of the crisis. I want to talk a little bit about just one, probably the most furthest advanced bit of financial innovation, and that's the peer-to-peer lenders. So the peer-to-peer lenders basically get rid of the banks in the lending space. At the moment, a bank intermediates lenders and borrowers. We put our deposits into a bank, and the bank takes it and then lends it out to a borrower. It sits in between us. The peer-to-peer lenders are also known as marketplace lenders or direct lenders, and they basically allow people to connect directly. So I, as a lender, can give my money directly to a would-be borrower. These platforms are well past the interesting experiment phase. In the US, Lending Club has gone public. It went public in December. It's the largest one worldwide. Prosper is its crosstown rival in the Valley. It will go public very soon. Funding Circle is a small business platform in the UK, which last week raised 150 million quid, despite not needing it. One of the backers was one of the early backers of Facebook. The outstanding portfolio of these different types of lenders is doubling every year, even as the balance sheets of traditional lenders is shrinking. These are tiny numbers still, no question. So Lending Club has lent in total about $8 billion to individuals and small businesses through its platform in the 8 years that it's been going. And that compares to outstanding credit card debt in the US of $800 billion and $300 billion worth of prime or credit-worthy borrowers. So it's only a small slice of the market. But if you look closely at what these platforms and their ilk offer, I think you'd be worried if you were sitting in the corner office of a big bank. Their cost advantage, and that's what this slide shows, is clear. They don't have branch networks. Their IT systems are less complicated and old. They rely more on word of mouth. They are just much, much leaner. And that means that they can sit neatly inside the spreads that traditional lenders make their money out of. They are very, very convenient. They are basically engineered around customers in a way that mainstream banks have long not been. So Funding Circle, most of its applications come in outside business hours. That doesn't matter. It's an online platform. And most of its applicants have actually been to a bank in the past and now switched. And they do so primarily because they say the process of trying to get credit out of an established institution is too long and too inefficient. The regulators love them, and that counts in this world. There are two sort of big problems, crudely put, with the banking system. One is leverage and the other is maturity transformation. And peer-to-peer lenders address both of those flaws. So in terms of leverage, it's not the bank, or rather it's not the platform that's on the hook if there are defaults, it's the end investor, the provider of capital. And in terms of maturity transformation, you put your money in and you only get it back when the loan that you funded has run off. That, at least in principle, is how it should work. And both of those things are very attractive in reducing systemic risk. Institutional investors are flocking to this platform as well. It's a chance to fund loans, which they haven't been able to do at scale before. 2/3 of the money that goes onto these platforms in the US is now institutional money, pension funds, insurers, hedge funds, and the like. So peer-to-peer is a misnomer. It's no longer individual, communitarian borrowing and lending. This is turning into a seriously big business with securitization, credit ratings, and all the rest. The banks aren't going to disappear. We shouldn't overhype this. But if you look at what these lenders are capable of, fast, efficient, cheap underwriting, then there's definitely a reason to be worried. And actually the advantages of the banks kind of crystallized down to some things which are really kind of worrying. Like, I have a branch network which is incredibly expensive to maintain and people are no longer going to. Or I have a government-backed deposit insurance scheme, which is the safety net that everyone worries about. So it's a worrying prospect for the banks. On the other hand, and this is both to wrap up and to bring us back to the issues I touched on in the middle of this speech, you can see already how the peer-to-peer lenders are going down the road that leads eventually and inexorably probably to trouble. So they're taking on the job of risk assessment. They started off with this very nice libertarian idea that you just let borrowers and lenders meet through an auction system. Basically, lenders would bid down the interest rate that they were prepared to pay until the market cleared. It turns out that both retail investors and professional investors are morons when it comes to auctions. They don't really care about whether they're pricing risk right. They care about winning the auction. That's all that matters. So they bid and bid and bid until it gets way too low. And they realized that default rates were spiraling out of control. Prosper briefly, which was at the time the biggest US platform, got into real trouble, had to close down briefly, partly because of regulatory intervention. And now they've gone to a model where they do the risk assessment and they put people into bands. And they assign letters, which look a little bit like credit ratings, to those bands. And A is good. And you can see that over time, people are going to get very seduced by that, just at the time when, in order to grow, those platforms are going to have to start taking on less creditworthy risks. At the same time, they're doing things that are not totally bank-like, but they're a little bit bank-like. So the idea that the default risk lies totally with the borrower, with the lender, with the provider of capital, is being whittled away at because a lot of these platforms now have provisioning funds. They're reserving bits of money and they're saying that if there are defaults, we'll just top you up from that fund. So the risk of default seems less present than it once did. They're developing secondary markets, which imply that you can sell your loans. And actually there is liquidity and maturity transformation, or the fact that you can't get your money back until a loan that you funded has run off. That's being whittled away at. And there are products in the UK that I think the regulator probably ought to be looking at, which are expressly promising money back before your loan has run off. So all of those sort of illusions of safety that people worry about and saw working to the disadvantage of the system in the run-up to the crisis and when it hit, you could just see them starting in the peer-to-peer realm too. And it's something to watch. So I think I'm going to going to stop there. My aim is not to persuade you that money is, or finance is the root of all good, more that finance is not painted solely in shades of black, that there are good things that finance can do, that there are creative people with a social conscience in finance, that it is not a terrible thing if all our graduates don't go into finance, that there is a role for people to go into this industry. And next time someone tells you that finance is good only for enriching bankers, I would urge you to think of some of these examples and the entrepreneurs and people that I write about in the book. Thank you very much for your attention. Yeah, there's...
Thank you very much. That was extremely interesting. There's another aspect, though, which you haven't touched on, which is the extent that investors in public companies, especially equity investors, can be a force for good by encouraging companies to behave in a responsible way. And there's a lot of, Norges Bank Fund, for example, trying to have ethical guidelines. And that strikes me as being quite an important Archimedean lever for getting the whole public company system to clean up its act. Do you have any comments on that?
Yeah, I can see that is a force for changing behaviour. I tend to be slightly more standoffish about it. So if things are legal and people want to transact in particular industries like tobacco or defence, then that's absolutely fine. You're probably thinking of things like divestment from fossil fuels, etc., which is kind of in the news at the moment. I can see that's a useful lever for investors to pull if they so wish.
More about things like sustainability and the classic tension between long-termism and short-termism in the company.
Yeah, I think that's that's a structure of markets rather than finance itself going bonkers. I think there are clearly things to do around the sort of frequency of reporting and what that does to the incentives of managers. There are clearly things to do around stock options and the incentives to hit strike prices at a particular time. There may well be some interesting things to think about in terms of ownership, although I'd say mandating different sort of classes of voting rights to reflect who's held shares for particular time periods, which is what they're doing in France at the moment, strikes me as completely ridiculous, because those long-term investors might include the state, which has not necessarily done the greatest job in terms of encouraging good stewardship of companies. I would say on the public markets, and this just sort of holds more generally, I'm pro-equity. I think equity is great. So the kind of big taboo, the big distorting policy is the privileging of debt in tax codes. And we see this with mortgages, clearly in the US still, but just across the board for companies, there is a great incentive to load up on debt. That, to me, is a huge distortion that doesn't get talked about, partly because it'd be almost impossible to work out how it would unravel and exactly where the ripple effects would be. But that in terms of kind of the sustainability of the system, the risks of systemic crashes, kind of doing more to guide people away from debt and towards equity would be a good thing. Two questions. You were first, and then there.
Hey, thanks for your talk. I'm not an economist by any means or anything like that.
Me neither.
So you might give me a really simple answer. I was wondering about this. It wasn't mentioned at all at this, and I'm not sure if it's mentioned in the book, but things like cryptocurrencies and that kind of stuff, does that have any potential to do anything, any good trends coming out of that kind of thing, or is that a complete...
That's a really good question. I'd sort of deliberately steered away from cryptocurrencies, partly because, as I found through this process, book publishing is kind of hostage to fast-moving events, and the price of Bitcoin is a particularly fast-moving event. So I think I think the interesting thing around cryptocurrencies, and it's not so much the sort of libertarian / anarchic case for Bitcoin or whatever it might be, it's the underlying technology, the blockchain idea. So this decentralized ledger that's a kind of transparent record of transactions that, in theory at least, is fraud-proof. There is a lot of interest and money going into startups now, trying to work out how can you apply this blockchain idea to the markets. So, we saw, for example, in the mortgage bust, the fact that the system had basically completely failed to keep up with transactions. By the time things hit the courts, no one knew who owned which securities because the reporting system just couldn't keep up. The blockchain might well be a way of answering that kind of question. So the sort of infrastructure problem of keeping up with a very fast-growing market potentially is interesting. There is money in there. I think it may well come to pass. I steered clear of it, but it is an interesting area. We had a question there.
So I was wondering, or I couldn't help but thinking when you were making some of your points earlier, that one of the problems isn't so much the financial engineering, but a lot of it goes back to the regulators and also to the ratings agencies back in 2007, 2008. So I was wondering, to what extent do you think that some of the regulation which is coming out from Dodd-Frank in the US, the swap execution facilities, etc., and also very similar things in Europe will help to mitigate.
So I think, broadly speaking, the regulation of the industry has been kind of pretty well calibrated and pretty good, broadly speaking. So that, capital and liquidity are clearly the right levers to be pulling in order to make the system safer, and we have a lot more capital around this. The latest sort of iterations of this have total loss absorbing capital of 20%. That seems pretty right. Liquidity too, I think they're sort of moving in the right direction. But there are some issues still. The rating agencies is just an incredibly difficult problem to solve. Dodd-Frank mandated the rating agencies somehow disappear. It's not clear how that's going to actually happen in practice. They are still completely interwoven in the Basel Accords, and even if they were got rid of, something else would pop up. There would be a letter scale that would represent a hierarchy of creditworthiness, and people will start to sort of behave in the ways I described around those. I think all the stuff around sort of, clearing and going onto exchanges with derivatives makes an awful lot of sense, but we are then shifting risk to another kind of very safe institution, which is the clearinghouse. So if you worry about, again, sort of heft and the illusion of safety, clearinghouses look undercapitalized, in my view. But I would give the regulators a kind of 7 or 8 out of 10 actually for what they've done to date. There's a question there.
Thanks. I actually have a question about the last slide. In some ways, those lending clubs, when they're small, sound a lot like the Isuzus in Nigeria or the Stokvel in South Africa, sort of informal groups of people that come together and lend money to each other. But when they're at that small size, they don't have all the benefits of the big banks. They don't have those huge pools of capital that can go to infrastructure investment and whatever, which are what developing nations are trying to get. But it also sounds to me like what you're saying is that once they achieve scale, they inherit almost by necessity all these negative things that you've spoken about. Are there policy implications along the way to stop the lending clubs developing into the banks, and what are they? Or do you think it's just a necessary function, it's almost a cyclical thing, that you're going to have these smallish saving circles growing, inheriting all these negative things that you've developed? Along the way, being able to provide big pools of capital, great, well done, then they'll crash again, and we start again with some different device.
So, I mean, the thing that would really kind of turbocharge my worries would be if they somehow got a deposit guarantee. And it's possible that they already talk about this, right? It's sort of very long term. This is why shouldn't people have money sitting in their account at a lending club or a ZOPA or a rate setter, and why shouldn't the government treat it as a guaranteed deposit-like pile of money? That would be absolutely terrible. But it may be that they'll do things which also make it feel like it's guaranteed in some way. There's no real safety. I'm not saying there is a total inevitability to this, that there has to be a crash at the end of it. But it is clear that the sort of pressure in the industry as growth takes hold is towards less good outcomes. So probably the single quote which most stayed with me from the reporting during the crisis was with someone who now heads one of the world's top 5 banks, who said that the only way that we can grow is by going down the credit ladder or taking on debt. That was an incredibly unimaginative statement, but it's also an incredibly worrying one. If that is really the only way that these things can grow, that means there will be something bad at the end of the process. So I think it's an argument for vigilance. It's an argument for the regulators being a little unpredictable, which is not something that we sort of institutionally at The Economist argue for. But the idea that every so often you kind of line someone up, you line them all up and shoot someone is not a bad way of regulating. You sort of that element of unpredictability may well be quite useful. I don't think there's a tremendous read across from sort of the Roscas and the kind of those savings clubs to what Lending Club et al. Did. They immediately enabled at scale sort of lending between strangers, and those savings clubs depend very much on kind of peer effects. You know who's in the village, and you're prepared to keep paying your money in. And there are attempts in Silicon Valley to try and create digital versions of these savings clubs, but they can't create the same bonds online that they can do in the village. Oh wow. Okay. Let's go to the gentleman in the third row first, and then we'll go there and there. That's 3, and then we'll come to you guys afterwards.
I'm wondering what your opinion is on short selling. I think a lot of unsophisticated investors tend to invest through funds, and in particular there's been a lot of that with respect to developing markets. I'm now reading that several hedge funds are putting a huge bet against the managers of these funds in the belief that there's going to be a big drop in the developing markets and therefore the funds. Seems to me this is a sort of a situation where the very sophisticated is going to clean out a lot of the unsophisticated investors. How do you feel about that?
I'm totally in favour of short selling. I think it's completely an important function of markets. Markets are about price discovery, and the idea that they can only go up is not right. So short selling is a helpful input into the price discovery process. And you see kind of, the likes of China, which is not a country that does things rashly, starting to encourage short selling is, I think, a useful indicator of how sort of people think about its roles, that it has a constructive role to play. Clearly, it sort of feels wrong at times, but I would point you back to property. This is an asset class where it's incredibly difficult to take bets against prices going up, and that's a real problem. And that's part of the reason why prices tend to rush ahead, is that you can't bet on declines. Or in order to do so, you've got to be massively sophisticated and take out credit default swaps on these strange synthetic instruments. That's why there are only about 10, 20 people that actually got really rich out of the bust, is because it was really difficult to short. So I'm a paid up believer. So we'll go there and then to the gentleman behind.
I've really enjoyed that talk. I thought it was great. You mentioned in your talk that Goldman Sachs had analysed 4.7 trillion, I think, in fintech and alternative kind of banking. I was wondering how you think the banks are going to react to this in the coming years, and what they're going to do about it, or what kind of market they're now going to look into.
So we're kind of moving from the denial phase right now. So, I mean, it was impossible to get anyone to talk about this seriously in the mainstream institutions until recently. It was dismissed, sort of hippy-dippy stuff, don't have to worry about it. Now things are clearly changing. So we have examples in the UK and the US of banks using these platforms to actually add to their portfolio. So small community banks in the US are investing in loans on Lending Club and Prosper in order to diversify. We see tie-ups between Santander and Funding Circle here. So there'll be a bit of co-opting, a little bit of sort of, dallying around with each other, seeing how things work. At some point, a bank will try to buy one of these things, and then I think it'll be an interesting moment for regulators to work out whether they think that's a great idea. So I think there is a bit of a race here for these things to get sufficiently big that they've kind of listed and they're difficult to take over, and the urge for banks to acquire. So we'll see a sort of drifting towards each other in various ways, a bit of cooperation, a bit of co-opting, a bit of acquisition. But I wouldn't expect the startups to disappear completely.
Thanks. Do you think that financial innovation is an evolutionary process that inevitably takes us all forward? So, because if it is, then you'd expect there to be lots of ideas that fail and go to the wall, so that the good ones survive. And in that context, subprime mortgages might have turned out to be a good idea. They didn't, but it's inevitable, and that's what we want, isn't it?
So subprime mortgages were an excuse for bad lending because people looked at the collateral and not at the underlying creditworthiness of the borrower. That's the sort of the real problem. It wasn't the subprime bit of it. It was the property bit of it that was really the problem. Property occupies this sort of. I'm slightly obsessed by it, but I think it's obsessional for lots of people because it turned into a kind of welfare state kind of mechanism too. It meant no one had to think, at least until now, about some of the distributional effects that are very, very current in politics today. I think lessons will have been learned from the subprime crash, which will be useful. So, payday lenders, it's hard to stand up and defend payday lenders, but there is much better underwriting going on now as a result of what we saw as during the subprime boom in the business sphere and also in the individual sphere. So people sort of grabbing data from all over the place and not relying just on the kind of experience and the sort of classic, rather blunt credit rating scores. There's a great company in the US called On Deck, which has also just gone public, and they target small businesses entirely, but they're just incredibly fine-grained underwriting process, which kind of I think is sort of builds on some of the experiences of subprime without falling into the trap of only concentrating on collateral. So I think it is evolutionary. There are some lessons there they will be learned from. There were some hands up there, so we go to that gentleman.
Has there been a very low rate of default by UK mortgagees in this recession? And was the collapse of the UK banks related to proprietorial investment in the US subprime market? And has your eschewing of qualifications in economics, finance or maths helped you to be untrammelled by the conventional wisdom to follow the banking sector and in writing your book?
So I'm not an economist. I was terrible at maths. My qualifications didn't really prepare me for this, I think. My qualification, I'll take that first. My qualification was not knowing much about the sector. When I got called into the editor's office. It's a very feudal system at The Economist. You get called up and basically told what you're going to cover. And I was told I was going to cover the banks, and this was summer 2007. And my response was a sort of sinking feeling. I am going to be covering an industry that makes money hand over fist for the next 3 years. It's going to be intensely boring. What on earth? How am I going to get through this experience? And it turns out I was thinking exactly like a financial regulator. I assumed that people were smart and competent. I didn't really have to worry. And then immediately the whole system collapsed, and it kept on collapsing. And not knowing anything was my greatest advantage. I could ask intensely stupid questions at a time when they were really appropriate. And your first question, sorry, can you repeat?
Has there been a very low rate of default by UK mortgagees in this recession? And was the collapse of the UK banks related to proprietorial investment in the US subprime market rather than individual mortgagees making bad investments?
So I don't think prop investments particularly made much of a difference except to RBS. RBS took on ABN AMRO. That was the thing that killed RBS. That was a really terrible and destructive acquisition, and they had a lot of US subprime stuff. The thing that really sank the British banks was commercial real estate, so not retail mortgages, but that was the sort of HBOS disaster. So it was much more on the office side of things. But I still think all of the reasons to worry about property kind of apply on the commercial side as well as they do on the retail side. It's still an asset that tends to suck up lots of capital without much thought. You have a question there?
First of all, thank you so much for coming today. I wanted to talk a little bit about mortgages, or ask you to talk a little bit more about that in terms of how to protect, or maybe how to help unsophisticated investors enter into mortgage agreements, and how to protect them from a situation like the financial crisis where they're entering into something and you have a professional on one side and an unsophisticated investor on the other. And if the professional is telling them certain things, it can be easy to enter into agreements they are not wise. Is there a way to protect that or against that on the unsophisticated investor's side?
Yeah. So there are changes, and particularly here the mortgage market review means that you're kind of jumping through many more hoops, and I think on balance that's probably quite a useful thing to have changed. You could imagine products like shared equity, where you're not as exposed to the downside as in a traditional mortgage being useful. There's a firm called Castle Trust, which is a UK lender, very new, very interesting, which is trying to change the way that we think about mortgages. It writes shared equity mortgages, so it takes, basically there are no capital repayments, no interest payments, but you give up a large slice of the upside gains and you take a little bit of the, and they take a slice of the downside movements, if there are any. The trouble is, nobody likes these things when prices are going up. Nobody's prepared to sacrifice the upside, and that's the problem with the model. They find it really difficult to get people to bite because everyone can see prices going up with good reason, given the way that the policy environment is set up. My preferred solution to the problems of property is not particularly helpful to individuals who aren't on the property ladder, and that's loan-to-value ratios. I think there should be much tougher requirements on the amount of deposits that people put down. And I realise there's an unpleasantness to this. I speak as a homeowner, telling people that you have to put down an incredible amount of money in order to get onto the property ladder. But I think that's in the absence of a really big supply response, and that would be ideal. But in the absence of that, that's probably the thing which would sort of help to alleviate price rises and increase financial stability. We have someone here.
Thanks for that interesting talk. I have to agree with a lot of what you say because I work for a social impact for private equity fund. My question was around property. You kind of alluded to it there, but I wanted to ask if there's any countries that have got this model right, and as a result, has that reduced any potential recessions in the same way that they've hit over here?
So, the obvious example is Germany. The trouble is, it would require us to be German. So it's very, very entrenched culturally, the attitude towards renting in that country. So it's a nation of renters. People move into homes, but much later. And there is a whole setup there with loads and loads of institutional capital that is happy to go into the rental economy. Tremendous rules that govern the price rises, so there's protection for tenants as well. But the whole sort of culture, the whole institutional setup is very, very embedded. And it's very hard to see that happening quickly here. And the idea that you get there just by capping rents, which is Miliband's latest proposal, this That's fine on one side, but you can't just do that. You have to have the institutional capital in there first in order for this to really take off. And you can't also be dangling goodies in front of first-time buyers. So Germany is the country that's got it right. Very hard to mimic it. In the meantime, I'd say, you know, if you had higher deposits, kind of enforce some of these processes of underwriting, of better products. This Castle Trust thing, just briefly on that, it reminded me that they have a really interesting and I think totally unique balance sheet approach. So the problem with normal underwriting is that you kind of, you know, you've got mortgages on the asset side of the balance sheet, and then your liabilities don't really change if there's a housing price crash. You've still got to pay back your lenders. Castle Trust have a matched balance sheet where they fund themselves with a product that basically mimics or whose returns are tied to national price house movements. So if there is a price crash, their assets go down, but they also have to pay their lenders less money because these investment products that fund them are tied to the price index. I'm not explaining it very well, but it's a matched balance sheet, and it's actually a really interesting idea. One there and one right at the back.
Hi. I guess I work as a quant in one of these big banks, and I find I'm a bit wary of these financial engineering for social purposes because of my experience in the bank. Because I've come across, I started my career after the crisis, but I've obviously learned a lot about what went on during that time. And repeatedly I come across some structure or some securitization, something where my initial reaction is, this is crazy, why would anyone do this? Then I find out a bit more about it, and it's like, that's actually quite clever, and it actually does solve a problem. But what went wrong with it? And often it's actually, I mean, partly it's what you said about investors not really being aware. But the other part is actually some people being too aware and being quite clever in terms of, because their incentives aren't aligned with the incentives that the product is actually trying to help. And so, you know, whether it's like finding some way in which the regulatory treatment's better, or, you know, some way in which it actually benefits them, they push something way beyond what it's supposed to be used for. And I guess that's why, I mean, well, that seems to be a general problem in financial engineering, and particularly when it comes to social applications. I find myself a bit, say, skeptical about whether this sort of thing wouldn't happen.
So, I think skepticism is absolutely the right way to think about almost anything connected to finance. This book is contrarian in the sense that it's not just slamming the industry, but it's not an apology for the industry. I would say that using financial engineering for social ends is better than using financial engineering for unconstructive ends, like getting into ever bigger mansions in the States. So that's one thing. That there is a certain level of complexity beyond which you shouldn't go, and then there is a level of complexity which is, I think we can handle. So the drug portfolio example I mentioned is pretty simple. It's really not engineering in the sense that it's kind of trying to create and obfuscate sort of new ways of enriching their inventors. So I don't know that there's a great answer to that question, but I do know that most investors put their money into debt-like products. About 3/4 of the stock of outstanding financial assets is in debt rather than equity. People like debt. They like the security of debt, and securitization can be a way of increasing that level of security without encouraging bad outcomes. I mean, you can make these things bankruptcy remote. The tranching actually worked during the crisis. It actually worked as it should have done. And if you look at a CDO, in many ways, it's less complex than a listed company, right? I mean, on a listed company, suddenly you can be owning on the asset side something you had no idea you were going to be owning. Because there'll be a merger or a takeover or whatever, and suddenly what you thought you owned is totally different. CDOs contained the same assets; they didn't change. They were just terribly underwritten, and their performance got worse. I'm sort of comfortable with financial engineering beyond and then there's a certain point at which you need to get vigilant. But I think also you should be aware that the simple stuff can go really badly wrong too. The counterfactual to all the securitization and CDSs and complex instruments that went so badly wrong is, okay, if that hadn't had happened, the banks would have just done the same lending on balance sheet in a simple form to the same effect. Single biggest set of quarterly losses during the crisis was Wachovia, which is a simple retail bank, which just happened to write terrible mortgages. None of the complexity was there, it just did a really bad job of underwriting. There was someone at the back.
A recent Reuters special report on US banks suggests that they're getting back to their ways in 2008. And also, have any anthropologists commented on smart money?
Have any
anthropologists commented on smart money?
No one's commented on smart money yet. So I'm waiting. It's out in 2 days, so you know that's when people will comment. The anthropological side of things, I mean, that's kind of the behavioural finance element to this. I mean, it's thinking about how people herd and behave in response to incentives. Gillian Tett writes about this a lot, and she has a book coming out on anthropology and risk fairly soon. So that will be slightly less good than mine, but it will be it will help you. And I'm sorry. The first question was sort of, are the banks up to their old tricks? Is that what you?
Yes, basically.
They're not up to the same.
Repackaged systems worse than 208.
No, I don't think they're not up to their old tricks in the sense of a very complex and opaque parceling and distribution of risk. Lots of the worst products have disappeared, and it's very hard to see them coming back in the foreseeable future. But it depends what you mean by the old tricks. You know, as I've tried to indicate, I think the stuff we think is fine is really dangerous. So that if they're not up to their old tricks in the sense they're not producing whizzy, turbocharged, devilish new products, that's not a reason to feel safe. It's much more the kind of humble lending, particularly property, is where the danger lies. So I think in that sense they're probably up to the same things as they were before. It's just we feel much more comfortable about this, and we probably shouldn't. Okay. We're going to get taken down now.
No tricky questions. I'm just looking at this picture here. Have you come across similar entities like Lending Club, but more equities based? I mean, Andy Haldane tells us that there's too much debt going on, and we should just try to tweak this somehow and get people not to lend debt, but to invest in various companies, small companies, and to diversify that way. And we may have a bit more risk, but for society in total, it may be much safer than just thinking of debt first. You mentioned that people think debt first and then equity. Have you come across any solutions to that problem to become more like Americans and accept some sort of investment risk, but as a result, construct a system which is much less prone to debt-related issues?
So the sort of systemic answer to creating that nice outcome is around the tax breaks and that I mentioned before. There are examples of equity crowdfunding, as I'm sure you know. So, and in some ways, the UK is much more progressive on this than the States, which is following the example of Europe and specifically Britain. So, Crowdcube is the largest equity funding site in the world. Cedars is catching up quickly. This is often regarded, and the idea is just like the lending platforms, you put your money in, but as an equity investment into a very, very young company, often no more than a business plan. And most people regard this, or lots of people regard this as basically a way to rob people of their money. That it's a terribly bad idea. I think there's a kind of basic restraint of trade sort of argument, which says that if people want to put their money into these things, that's absolutely fine. We allow them to play the lottery, and that's no problem. And in fact, the quality of some of the sort of discussion around these ventures is really, really very high. And what's interesting is that VCs, so the professional investors, are now looking at these platforms as a way of validating ideas. So the initial worry was that equity crowdfunding platforms would be, these are the ventures that the smart money, the professional money has passed on. And so all the dumb money will end up taking the rubbish that's left over. In fact, what's happening is that ideas that get validated by the crowd, so lots of money coming in from people who, are perhaps individual investors, is a way for people to test the qualities of the entrepreneur. They're able to connect with a market and sell the idea, and that's actually a really important skill if you're setting up a business, and a way of validating demand. So if you have a consumer-facing product and lots of people are interested in it, that's a great sort of way of focus group testing the product. So equity crowdfunding is an interesting idea. Again, it's still pretty young, but it's an example of the fintech wave in that space.
So if there are no further questions, let me thank Andrew for this very...
Thank you for the questions. That was great. Thank you.